Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Coming up on the show today, first we're diving into a shocking 30.2% spike in UK airfares that's putting the Bank of England and its governor, Andrew Bailey, in a real bind. Then, a new MIT study drops a bombshell on the AI industry, finding 95% of projects yield zero return, just as OpenAI's Sam Altman urges caution and all eyes turn to Jerome Powell. And finally, we'll see how a huge 93.5% US tariff on Chinese graphite is creating a mad dash, with India's Epsilon Advanced Materials sprinting to build a $650 million factory in North Carolina. Let's start with a single statistic that might just change your entire perspective on inflation. Airfares in the UK just posted their biggest monthly jump since records began in 2001, a staggering 30.2% spike between June and July. So how is a jump like that even possible? Well, the thing is, airlines are increasingly using sophisticated dynamic pricing algorithms. These are AI-driven systems that adjust fares in real time based on demand, competition, and even your personal booking patterns. Some are even designed to find the absolute highest price an individual is willing to pay. When data collectors happen to check prices during a peak window, these algorithms can create a massive temporary spike that gets baked right into the official inflation numbers. That massive leap is a key driver behind the UK's latest inflation, which just clocked in at 3.8%, the highest since January, and still well above the Bank of England's 2% target. And it's not just travel. The cost of food and non-alcoholic drinks is also climbing, marking the fourth straight month of increases. Prices for items like beef, chocolate, and instant coffee are all pushing higher, bringing food price inflation to its highest point since February. What's often overlooked about these specific hikes is that for items like beef and coffee, the supply chains are incredibly vulnerable. Interestingly enough, the industry is fighting back with technology. We're seeing major investments in computer vision to maximize meat yield from each animal and blockchain for transparent farm-to-cup coffee records. These agri-tech solutions are designed to build resilience and hopefully insulate us from this volatility. But this is where the situation takes a more complex turn. This inflation shock comes just after the Bank of England narrowly voted to cut interest rates to 4%, their lowest in over 2 years. Now, policymakers are caught in a difficult balancing act. Do they fight rising prices or try to boost a sluggish economy? This kind of volatility is something traditional economic models have really struggled to predict. To get a better handle on it, the Bank of England is increasingly turning to artificial intelligence. They're actively developing AI workflows that can analyze vast amounts of data, even the sentiment in news articles, to forecast things like inflation and unemployment more accurately. They're hoping these new tools can help them navigate these shocks more effectively. Economists say this data strengthens the case for slowing down any future rate cuts. The bank's governor, Andrew Bailey, recently warned that while rates are on a downward path, any future cuts will need to be made gradually and carefully. The ripple effects are already spreading. Another inflation measure, the Retail Prices Index, or RPI, is used to determine upcoming hikes in train fares. It just rose to 4.8%, which could mean a rail fare increase of 5.8% in 2026. Now, get this, that RPI number is actually quite controversial. Many economists consider it a flawed and outdated way to measure inflation. In fact, the UK's own Office for National Statistics declassified it as a national statistic back in 2013 because its formula tends to overstate inflation. The reason it's still used to set your train fares often comes down to legacy government contracts and a policy of shifting railway costs from taxpayers onto passengers. With inflation heating up unexpectedly, the Bank of England now faces what one economist calls a close call on its next move. The question on everyone's mind is, was the recent rate cut a one and done, and are UK households in for another wave of cost of living pain? We were just talking about the Bank of England using AI to navigate economic shocks, but let's shift focus to the AI industry itself, where a new MIT study suggests the hype is running far ahead of reality. It found a staggering 95% of organizations are getting zero return on their AI investments. Believe it or not, companies are pouring billions, $35 to $40 billion in the US alone into AI, but only 5% of those projects ever get successfully deployed. The gap between hype and reality is massive because many AI projects aren't tied to clear business goals. The data they're fed is messy, and there's huge organizational resistance from employees who fear for their jobs. This bombshell drops just as the AI-fueled tech sector is showing serious cracks. After rocketing over 50%, the rally has hit a wall. High flyers are getting hammered, with Palantir Technologies slumping 16% recently, and even the Titan Nvidia has dropped about 5%. The situation presents a fascinating duality. On one side, you have companies like Nvidia selling the picks and shovels, the chips that power everything and making a fortune. On the other, the companies actually trying to use AI, the gold miners, are struggling. A bizarre paradox is emerging where the very tool for success could also be the instrument of disruption. After all, why pay for specialized software if a powerful AI can do the same job for less? And if you think that's just market jitters, the CEO of OpenAI, Sam Altman himself, just went on the record warning that investors may be getting overexcited about AI. The man at the center of the revolution is telling everyone to pump the brakes. What really brought this to a head was the next development. The tech sector's share of the S&P 500's total market value is now approaching its highest level since the dot-com bubble of 2000. We all remember how that story ended. However, if you zoom out, you'll see this isn't a perfect repeat of history. Back in 2000, you had companies with no profits. Today's AI titan, Nvidia, is a different beast entirely. Its revenues soared 126% last year to over $60 billion, and its profits grew almost 600%. So while the valuations are sky high, they are at least tied to real massive profits, a fundamental difference. But the main event is unfolding right now. All eyes are on Federal Reserve Chair Jerome Powell and his upcoming speech at Jackson Hole. The market is pricing in an 84% probability that the Fed will cut interest rates in September, a move that could pour more fuel on the fire. But if Powell pushes back, he could trigger a massive unwind. So the reason AI stocks are so uniquely vulnerable to interest rates comes down to a kind of financial gravity. The value of these high-growth companies is based on profits they expect to make far in the future. When the Fed raises interest rates, it makes those future dollars worth less today. This effect is far more dramatic for a company promising huge profits in 10 years than for one making steady money right now. That's why even a hint of higher rates can send these stocks tumbling. This all begs the question, is the AI boom facing its day of reckoning, or is this just the tremor before an even bigger earthquake? Remember, all market information is volatile, and this is not financial advice. Speaking of major market disruptions, a geopolitical chess move just sent a shockwave through the entire electric vehicle industry. The United States has slammed a punitive 93.5% tariff on a critical battery component from China, effectively disrupting a massive global supply chain overnight. And in the ensuing chaos, one company is moving at lightning speed. India's Epsilon Advanced Materials is now in a dead sprint to lock down deals with Japanese and South Korean battery makers inside the US. This move is perfectly timed to capitalize not just on the tariff, but also on the US Inflation Reduction Act, which provides massive incentives for companies to produce battery components on American soil. It's a golden opportunity for a non-Chinese supplier. According to Epsilon's managing director, the shift has been dramatic. He says just last month, potential buyers were in a wait-and-see mode. His new forecast? He expects to close major supply contracts within the next 60 to 80 days. To back it up, Epsilon is putting a shovel in the ground on a $650 million factory in North Carolina. But that's not the whole picture. That $650 million bet is a high wire act, almost entirely dependent on that huge US tariff on Chinese graphite staying in place. If a future administration changes that policy, the plant's economic advantage could vanish. And here's the bigger question. This new plant will process graphite, but where will it get the raw, unrefined material? If the feedstock still has to be imported from China, it begs the question of how much this truly decouples the supply chain. This decision brings both huge opportunities and comes with inherent risks, because China currently refines over 90% of the world's graphite, the material, in nearly all EV battery anodes. The US needs 500,000 tons of it a year, and its primary supply line was just severed. This isn't just about tariffs, it's a direct challenge to a near total monopoly. And breaking that monopoly is, incredibly difficult. The reason China is so dominant is because producing battery-grade synthetic graphite is a massive technical challenge. It requires purity levels over 99.95% and heating materials to an insane 3,000 degrees Celsius. It's an energy-intensive process Chinese companies have perfected. For a new plant to match that quality and scale right away is a monumental task. And here's where it gets really interesting. While Epsilon races to become a key supplier to the US, the company is struggling to win over its own domestic market in India, where customers are still drawn to low-cost Chinese materials. Epsilon's chief is now issuing a stark warning, urging them to secure an alternative before, in his words, China closes the tap. When we place Epsilon's global ambition alongside its domestic struggle, the contradiction becomes clear. India has its own major Make in India initiative designed to boost domestic champions like Epsilon. Yet, on the ground, the reality of global price competition wins. Indian buyers find it hard to turn down cheaper Chinese options, even if it undermines their own country's industrial goals. The battle for the future of the EV battery supply chain is no longer a distant forecast. It's a high-stakes race happening right now, with new industrial alliances and fortunes being forged in a matter of weeks.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.